Banking for production, reclaiming credit for national development. It is not by augmenting the capital of the country, but by rendering a greater part of that capital active and productive than would otherwise be so, that the most judicious operations of banking can increase the industry of the country. Adam Smith, The Wealth of Nations. So this is a very positive statement on banking from Adam Smith in his book, his seminal work, The Wealth of Nations. Adam Smith's observations remain a precise diagnostic tool for modern economies. The problem is rarely the absence of capital. It is the failure to mobilize its failure to mobilize it productively. In Trinidad and Tobago today, billions of dollars sit within the banking system as excess liquidity. Treasury bills and notes are routinely issued to absorb that liquidity and prevent interest rates from collapsing. Commercial banks and other financial institutions are flush with deposits, yet productive sectors, particularly small and medium enterprises, remain undercapitalized. The paradox is stark: abundant money, insufficient development. The issue is not whether capital exists, it is whether it is being directed towards production. A brief history of banking and credit. To understand the present dysfunction, it is useful to revisit the origins of banking. Early commerce relied on barter, an inefficient system constrained by the double coincidence of wants. Gold emerged as a universal medium of exchange because of its durability, divisibility, and perceived intrinsic value. Goldsmiths, equipped with vaults and reputations for trustworthiness, became custodians of gold deposits. In time, depositors began transferring ownership not by physically moving gold, but by issuing written notes instructing the goldsmith to pay a bearer on demand. These promissory notes evolved into paper currency. Over time, gold itself remained dormant in vaults, while notes circulated freely. Eventually, goldsmith bankers realized they could issue more notes than the gold held in reserve, thus giving birth to fractional reserve banking and credit creation. Loans were extended, primarily secured by land and property. This expansion of credit was instrumental in financing the agricultural and the industrial revolutions, underwriting machinery purchases, and commercial ventures. Credit, properly deployed, accelerates production, but from its earliest evolution, banking culture favored security over innovation. Collateral, especially land, became the principal determinant of access to credit. Wealth begot access. Access begot more wealth. Structural inequality was embedded within the system. From conservatism to speculation. For centuries, banks maintained a conservative lending ethos. Yet in recent decades, that caution has oscillated into periodic episodes of reckless expansion. In the 1980s and 90s, flush with oil revenues and global liquidity, banks extended massive loans to developing countries for poorly vetted projects. When commodity cycles turned and economies contracted, debt burdens became unsustainable. In the 2008-2009 global financial crisis, this exposed a more insidious flaw. Financial institutions trading opaque mortgage-backed securities with one another, instruments that proved fundamentally unsound. Insolvencies cascaded through the Western banking systems. Governments intervened with unprecedented monetary expansion, effectively creating money ex nihilo to prevent systemic collapse. The lesson was clear. When money expands without corresponding increases in real production of goods and services, the result is inflationary pressure, currency debasement, and misallocation of resources. The Trinidad and Tobago context. Trinidad and Tobago presents a different, though related, anomaly. The system is not currently constrained by liquidity, it is constrained by allocation. Billions of TT dollars remain idle or are channeled into low-risk, low-impact instruments. Meanwhile, artisans, small manufacturers, farmers, and service providers struggle to access financing. Electricians, plumbers, carpenters, furniture makers, textile producers, potters, and small business operators often lack the conventional collateral banks demand. Their balance sheets are thin, their property holdings minimal, yet many possess viable skills and business concepts capable of generating real output, employment, and multiplier effects across communities. The modern banking portfolio, however, is heavily weighted towards consumption lending, vehicle loans, credit cards, personal lines of credit, mortgage beyond basic shelter needs. Consumption expands aggregate demand, but does not necessarily expand productive capacity. When consumption outpaces domestic production, imports rise, foreign exchange drains, and structural vulnerabilities deepen. If banking is to serve national development, it must pivot from collateral-based conservatism and consumption bias towards production-centered credit policy. Reframing the role of banks under an SVT regime. Under an SVT, side value tax regime, where land is taxed based on its unimproved value, speculative holding of idle land becomes economically unattractive. Land must be used productively or relinquished. In such an environment, banking policy should align with the same developmental logic. Prioritize production over speculation and essential needs over luxury consumption. A rational tiered lending structure could be implemented. 1. Lowest rates, productive investment. Loans for the production of goods and services, manufactured, agro-processing, technology services, crafts, value-added industries should receive preferential rates. The objective is to expand the nation's capital stock and output capacity. 2. Moderate rates, basic housing and essential facilities. Financing for adequate housing and essential infrastructure should be supported, but structured to discourage excessive luxury beyond reasonable standards. 3. Higher rates, discretionary consumption. Non-essential consumption loans should attract higher rates, reinforcing thrift and prioritizing savings for discretionary spending. Such a structure does not eliminate profit. On the contrary, by financing thousands of productive enterprises rather than a narrow class of large borrowers, banks expand their lending base and diversify risk. Profit is earned across volume and economic vitality rather than scarcity and exclusivity. Production as the true collateral. Traditional banking evaluates borrowers primarily through collateral and static balance sheets. A production-centered system would incorporate dynamic operational metrics, efficiency ratios, cash flow projections grounded in real market demand, productivity benchmarks, and sectorial relevance to national development goals. The true collateral of a productive society is output. When thousands of entrepreneurs operate profitably, default risk declines systemically. Businesses can emerge, acquire, or absorb weaker competitors in a healthy economic ecosystem. Non-performing loans diminish because economic failure becomes an exception rather than a structured feature. Banks would assume a more developmental role, conducting periodic audits, providing advisory support, and ensuring operational discipline among borrowers. This does not imply bureaucratic intrusion, but professional oversight aligned with long-term viability. Education, institutions, and ecosystem effects. Credit expansion alone is insufficient, and educational reorientation is essential. Entrepreneurship, financial literacy, cost accounting, and operational management must be embedded across the educational spectrum. State institutions, industrial development agencies, small business support entities, venture capital networks, the stock exchange would experience expansion as new enterprises seek equity participation and capital market access. Insurance firms, building societies, and investment houses would similarly benefit from increased economic dynamism. With broader participation in productive enterprise, savings rates could rise organically, reinforcing capital formation. Competition within the banking sector is equally critical. A concentrated banking oligopoly tends towards risk aversion and portfolio homogeneity. Greater entry, domestic or regional, would compel innovation in credit assessment and customer service. Breaking the boom-bust cycle. Speculative land deals and grandiose projects divorced from productive fundamentals are hallmarks of boom periods. Under an SFT framework, combined with production priority banking, speculative holding becomes costly. Credit would not be extended at concessional rates for land hoarding or vanity developments, misaligned with national priorities. This alignment reduces the amplitude of boom-bust cycles. When credit fuels productive capacity rather than asset inflation, downturns are less catastrophic. Banks avoid the cycle of foreclosure and fire sale liquidation that typically accompanies recessions. Households avoid the trauma of widespread insolvency. Money as servant, not master. A fundamental conceptual shift is required. Money is the servant of credit, not its master. Credit becomes abundant when the factors of production, land, labor, capital, entrepreneurship, are efficiently coordinated. It becomes scarce when these factors are fragmented or misaligned. The state's role is not to micromanage banks, but to create a policy environment that incentivizes production-oriented lending. Regulatory frameworks, tax policy, and development strategies must converge toward a singular objective: activating dormant capacity toward an optimized economy. If banks reorient their portfolios towards production as the primary objective and consumption as secondary, several outcomes follow. Idle liquidity is mobilized, small and medium enterprises expand, employment rises, import substitution and export diversification improve foreign exchange stability. Default rates decline through systemic economic health. Inequality narrows as access to capital broadens beyond the property elite. The transformation is not utopian, it is structural. Banking institutions already create credit beyond deposits. The difference lies in distribution. When credit is restricted to a narrow segment of collateral-rich borrowers, systemic productivity remains suboptimal. When distributed across a broad base of capital producers, national output expands. Adam Smith's principle remains unchallenged. Banking increases industry not by increasing capital per se, but by activating it. Trinidad and Tobago does not suffer from a shortage of money. It suffers from a shortage of productive mobilization. The proposal is therefore straightforward. Under an SVT-aligned regime, banks must prioritize credit for production, moderate essential needs responsibly, and price discretionary consumption accordingly. Competition within the sector should be strengthened. Oversight should focus on operational viability rather than mere asset backing. Education must support entrepreneurial competence. If implemented coherently, such a system would transform the economic landscape. Capital would cease to be idle, land would cease to be speculative, labor would cease to be underutilized. Banking would finally fulfill its proper function, not as custodian of wealth alone, but as catalyst of national development. Thank you. You can get more on the subject by going to our Linktree link at https://Linktree/Nigel Gittins. Here you will get access to all my books and courses.